Hey guys, this is Nick from Financially Aware, and in this video I'm going to talk about the GNC bankruptcy, and I'm going to talk about the two plans that they put forward in the bankruptcy court, how they work, and how neither one of those are going to be good for stockholders. They're still going to get wiped out. So long story short, do not buy this stock, but I'm going to explain the two plans, how they work, and later on in the video I'm going to do an example of the structure of GNC and the debt, the preferred stock, the common stock, and how the two plans that they put forward will work to basically wipe out the common stockholders. So stay tuned for that. So if you don't know, GNC is a big vitamin and supplement kind of seller in the US and globally. They have something like 7,300 stores. In the US, they have like 5,200 stores, and 2,600 of those stores are company owned. The rest are franchises. And so the franchisees in the other countries are not part of this bankruptcy. It's just the US stores. And in this bankruptcy, it's a Chapter 11, so it's going to be a reorganization. A lot of people get confused by that, thinking that that means that if they buy the stock, they'll be able to share in the reorganization. But the truth of the matter is, during the reorg, the old shareholders get wiped out, and there becomes new shareholders that have nothing to do with the old shareholders. So even though they're going to close around 800 to 1,200 stores to reorganize and keep the profitable stores open and cut down the unprofitable stores, you as a shareholder buying the stock now will not see any of that, because both of the plans that they put forward will wipe out the current stockholders. So GNC has about $900 million in debt, and right now there's two plans that they're pushing in the bankruptcy court. One of them is for Harbin Pharmaceuticals, a Chinese company that already owns $300 million in preferred stock in GNC. They proposed a plan to bid $760 million for the company. So in this plan, they would pay $760 million. It would pay off the secured debt holders and some of the unsecured debt holders, not all of them. And so they would take over the company, and that would be that. The existing shareholders would get ripped up, and Harbin would own the whole company, and maybe at some time later they can do a new IPO and float new shares, but it will have nothing to do with the current stockholders. And so the bid they put in is called a Stalking Horse Bid, and what that is they put in a minimum bid that's high enough so that it will keep people from trying to throw in low bids to try to buy this company for nothing, and in return they have like some breakup fees if somebody bids higher. Now somebody can bid higher than the $760 million that Harbin is bidding, but it's not very likely. Already they said that GNC has talked to about like 50 other potential investors, and none of them were biting to invest. So probably the only reason that Harbin Pharmaceuticals is even bidding on this is because just in like 2018, they sunk $300 million and got preferred shares in GNC. So they kind of don't want to see their $300 million get wiped out. So maybe they're adding good money after bad. I don't know. But they're willing to pay $760 million, but that's still not enough to satisfy all the secured and unsecured debtors, debt holders. So even that, some bondholders will not get the full amount they're owed, which means that the shareholders will definitely get nothing. And that's even in the bankruptcy plan that they put out. So you can read that in the filings yourself. Now, if this plan doesn't go through, the sale transaction, they have a different thing called a plan transaction. And the plan transaction says that the bondholders will get, the secured bondholders will get 100% of the new common stock. That is in the filing. So if you don't believe me that, you know, the old shareholders get ripped up, go read it yourself. It's there. It says the new common stock. The bondholders will get 100%, and they will have 10% set aside for future dilution to pay off management and employees with, you know, stock compensation, which is kind of weird because, you know, these are the same management that drove this company into bankruptcy, and they're setting aside 10% for them to get, you know, compensated more in new stock. You know, that's how it works basically. And for the unsecured creditors, they have the option of getting 3-year warrants for up to 5% of the new stock, or pro rata share of $250,000. Okay, so what that means is, you know, you can get a small percentage of 5% of the future shares, or we can give you $250,000 for you guys to split amongst yourself in a percentage of the unsecured debt that you held. And just to give you an idea of how much is held in unsecured debt, there's also a whole list of the unsecured debt holders in the filings as well. And some of the big ones are Bank of New York Mellon has 157 million. Simon Property Group, the mall owner REIT, owns like 4.5 million of the unsecured debt. FedEx is even owed 1.4 million. So just right there, that's, you know, $165 million. And there's a bunch more, a bunch of the, you know, the suppliers of the vitamins and the supplements and all those companies are owed a whole bunch of money, and they're also unsecured. So you're talking probably 200 million or more in unsecured, and they're going to share $250,000. Okay, so if that's what the unsecured get, what do you think the common stockholders get? A big fat zero, of course. Now, just to show you how the capital structure of a company works, here's an example. Here you have the company, and next to that, the closest to that is the secured debt. Next to that is the unsecured debt. And then comes preferred stockholders, and then way at the end is common stockholders. And so normally, let's say the company makes some money, right? They make $4 million, $4 billion. They have to pay the secured debt first, then the unsecured. They have to pay them together because either one of them not paying could force them into bankruptcy. Then they pay the preferred shareholders, and then dividends or anything for the common shareholders. Okay, now, let's say in a quarter, they didn't make 4, they only made 2. They have to pay their debt, but they don't have any money to pay the preferred, and the preferred is cumulative. So what that means is if they don't pay you this quarter, they owe you for next quarter, or they have to pay you out in common stock. So next quarter comes and they make 4 again, right? They make 4, and so they go to pay out 1 for this secured, 1 for unsecured, 1 for preferred, and 1 for common, right? No, because they're still owed 1 from the last quarter, so they get theirs and the common gets nothing. So you see, it's like water flowing downhill. The debt is the most important, and then the preferred, and then the common. So in this case, the sale transaction would be something along this lines. So let's say that the debt is $900 million, right? And let's say 7 of that debt is secured and 2 of that debt is unsecured, right? So this is what has to be paid off before any money can flow to the preferred or the common stockholders. But in the first case, the sale transaction, right, Harbin Pharmaceutical is saying, well, we're not paying you $900 million. We'll pay you $760 million. Okay, so what does that mean? That means let's say 7 goes to the secured to pay that off because they have to get paid off first, right? And then only, 60 million instead of 200 million goes to the unsecured, which means this guy's not completely paid. And so that means that these guys get nothing. And so what they're saying is we're going to make it, these guys are saying they're agreeing to say, look, we'll take, say, 60 million instead of 200 million because it's better than nothing. And so that's what Harbin Pharmaceutical is doing. They're saying, okay, we're going to pay you, these guys, secured gets the full amount, unsecured gets a partial amount, and they're going to retire their debt. And Harbin is going to own the whole company. There's going to be no more stockholders, right? And they can own it privately or whatever they want to do, right? They'll own the whole thing. And then maybe if things turn around, they close some stores, sales increase and stuff like that. They close the stores that aren't doing good and keep the better ones open. Hopefully down the road, they may do an IPO and sell stock so they could recoup some of their money or recoup all of their money or something along those lines. So that's what would happen with the sales transaction. So in the case that the sale doesn't happen and they have to go to the planned transaction, the way that would work is they would reorganize and cut out the stores that they need to cut out, and the bondholders would take 100% of the company in new stock. And what would happen is they would actually get a new loan called a DIP, debtor in possession loan, to let the company run and pay the vendors and stuff while they're working this plan through. That's supposed to happen like in the fall or something like that. So like I said, secured debt gets paid first, but when you're in bankruptcy, the debtor in possession loan goes in front of the secured debt. So now they know that anybody that's lending money for the secured, the debtor in possession is going to get paid even before the secured debt or the unsecured or anybody else. So it's a very safe place to be. So when any money flows, it's going to go debtor in possession, secured, unsecured, whatever. But even in the plan that they say that 100% is going to the secured debt holders, and then 10% of that is going to go to the management, plans for, retention and all of that stuff. And these unsecured guys, whatever, this gets paid first, then this gets paid, and then maybe some of this gets paid, but not the full amount. And so whatever's left, these guys get to split either warrants for 5%, or they get to split a whopping $250,000 based on how much they're owed and what percentage they're owed makes up that pie of the unsecured debt. So what happens to these guys? Preferred, gone. Common, gone. And so these guys say, okay, we are gonna rip up this debt, right? No more debt. And we are going to own this company with new stock. So we're going to replace our debt for new stock, and we will own the whole company. And this is new stock, has nothing to do with the old stock that's trading right now. So that's how it works, and that's why the old stockholders will get nothing in either one of these plans. Okay, so I know people hold high hopes and they go, oh, they're going to reorg, they're going to cut some stores, they're going to do this, they're going to do that. Yes, that's true. They're going to stay in business most likely, but not with the old stock because they owe more than they can pay. And so those bondholders are going to take the whole company, or Harbin Pharmaceutical is going to buy the whole thing and keep it for itself and pay off the creditors, not 100%, but some high percent of what they are owed. So now that you know that the stock is worthless, I know that doesn't mean it's going to stop a lot of people from buying it, because people are looking at what happened to Hertz. It went from $1 to $6 even after bankruptcy. So, People think that they're going to be swift enough to get in and get out and just ride it for a pump and dump, whatever. I get that, but I don't recommend it. And so that's where I stand on GNC. So I hope you liked this video. If you did, leave me a thumbs up. It helps me with the YouTube algorithm. Leave me a comment below and let me know if this is going to change your mind on whether you were thinking about buying GNC and now you're not, or even after watching this video, you're still going to buy GNC because you think it might go to $2, $3, $4 like Hertz did. And as always, if you haven't subscribed, please subscribe to my channel now. Thanks for watching.